The name is bond, and I'll tell you why. June 28 is an important day for India's bond markets, for rupee, interest rates, and indeed the Indian economy. Starting June 28, Indian government bonds enter JPM's Global Bond Index for Emerging Markets, or GBIEM as it's called. Indian bonds are to have a weight of 10% in this index. The inclusion, however, will be phased, with 1% of the weight getting added every month till the full weight of 10% is reached in March 2025. Now, why are bond indexes important? The bond index is much like stock indexes, like Nifty and Sensex. Every pension fund and mutual fund around the world can't track bonds issued by every government all over the world and their macros, so they merely follow these global bond indexes. Now, what does inclusion in the JPM GBIEM index mean for India? Well, the total market value of bonds following the GBIEM index is about $300 billion. And so, inclusion in this index with a weight of 10% means that funds will purchase at least 30 billion of Indian bonds by March next year. That's the understanding. Typically, funds front run or come ahead of the inclusion. And dealers in India estimate that perhaps about $10 billion have already entered the country and are parked with various banks who could have warehoused bonds for these funds. Now, here's the month-wise flow of dollars into Indian government bonds. As you can see, from September, it's been increasing. That's when JPM announced the India inclusion. About 1 to 2 billion has been coming every month. As a result, foreign ownership of Indian bonds, which was as low as 1.9% of total bonds outstanding in September 23, has now reached 2.6% and is expected to hit about 5% by March 25. It's important to note that all bonds issued by the Indian government don't qualify to enter the GBIEM index. Only those bonds characterized as FAR, or fully accessible route bonds, are part of the GBI index. Earlier in India, foreign funds were allowed to own only 5% of any bond. But in February of 2020, 4 years ago, the budget enacted a rule that foreign funds will be allowed to buy some bonds without any limits. These bonds are the FAR, fully accessible route bonds. This enactment was an important step in getting India into the global indexes. As of today, about $400 billion worth of Indian bonds are classified under the FAR. Now, what's the advantage of foreigners buying Indian bonds? The advantage of index inclusion clearly is that there is one more big buyer buying Indian bonds, and therefore yields are likely to fall, thus lowering the cost of government borrowing. And this in turn may reduce the cost of capital for corporates as well. Dealers estimate that since 10 billion has already flowed, in coming months, at least $2 billion of bond buying will happen in each month, every month until March. Additionally, in March this year, that is March 24, Bloomberg included Indian bonds in its emerging market local currency index. This inclusion is expected to take effect from January of 25, and the estimates are it will bring in another $3 to $4 billion into Indian bonds. Now, will such a huge flow of dollars lead to the rupee appreciating? Well, Standard Chartered sees the rupee rising towards 80 to 70 per dollar by the end of the current year. However, the Reserve Bank may well buy up a good part of the forex flows to keep the domestic industry competitive. Now, with falling yields and a stable rupee, India's growth story can get even stronger. So, not surprising, India's equity indexes have been hitting new highs for the past many weeks.